Hey everyone, welcome back to my channel. My name is Elsie, and today we are going to be talking about a 401k change that you need to know about. And the reason I'm covering this specific change is because I just realized yesterday that the 401k that I contribute 21% each pay period towards through my employer is only worth $221. Now, I have been contributing to this 401k since I began this job in 2019. 3 years worth of contributions. Now, I did not start at 21%, mind you. I started at 3% and then ramped up to 21%. But $221 really makes you think. So before we get into how that number is calculated, what the heck it means, let's actually start with some background information to set the scene and get everyone up to speed on what the heck is going on with 401ks. So in 2019, there was this thing called the Secure Act. Now, Secure stands for Setting Every Community Up for Retirement Enhancement Act of 2019. Now, this was an act that amended the Employee Retirement Security Act of 1974. And what it did is it added 2 lifetime income illustrations, which have to be furnished at least annually to people with 401ks. And it has to be published on their benefit statements for their individual account plans. Okay? So within this Secure Act, essentially what happened is Congress came out and had 3 directives. They said, okay, what you need to do for these lifetime income illustrations is first, you need to issue a rule explaining how to calculate the lifetime income illustration, meaning you need to lay out assumptions and factors that plan administrators must use to calculate the estimated income stream provided by the account balance. Okay, so what this means is that under this new act, at least one time annually, if you are receiving a 401k statement, typically this comes out quarterly, on it there will be a specific section for what's called a lifetime income illustration. And what you will see is your current lump sum balance. You will then see 2 other numbers. The first number is going to show you what your lump sum balance would be at age 67 as a monthly payment. Okay, so it breaks that lump sum down into a manageable, hey, this is what your total account balance would look like as monthly income in retirement for you as an individual person. That's the first number. The second number is going to be for you if you have a spouse. So in that scenario, you're going to have a different amount of money each month that would go to your spouse upon your death. Okay, so it's going to be a little less than if it's just you by yourself. But essentially, Congress said, hey, those are the numbers that have to be on there, and you have to issue some kind of rule explaining how you're calculating those numbers. So that was the first thing. Then they said you have to explain it, right? So you have to issue language explaining the illustrations and assumptions, which we're going to get to in a couple minutes. And then lastly, they had to publish. So they had to issue the assumptions and model language within 12 months of the Secure Act being enacted. Okay, so what exactly is this lifetime illustration, and why should you and I care about it? So, like I said, essentially, your plan administrator is now required at least once annually to include 2 lifetime income illustrations on your benefit statement. Okay, so like I said, the LII consists of 2 items: a monthly income amount based on your account balance, as if it was a single life annuity, and then also a qualified joint and survivor annuity. So essentially a monthly income amount if you have a qualified joint and survivor annuity involving a spouse. So the idea is that by showing you your plan balance as a monthly sum instead of just a lump sum, two things will happen. One, it will encourage you to contribute more if you currently contribute too little. And then two, the hope is that by making this readily available, it will save you time because it will help you understand how prepared or possibly not you are for retirement. So in theory, this sounds really great, right? It's helping people break down that lump sum so that they can actually know, hey, month by month, this is the exact amount of money I would be receiving. So how do they actually come up with these numbers, right? If you remember, Congress said, hey, you have to explain how you're coming up with those numbers. So there are 5 assumptions used to calculate this monthly income statement, okay? So the first one is the assumed commencement date, okay? So when they are calculating your monthly income amount, they are assuming a commencement date, and that is the date that the annuity payments begin. And that, in this scenario, is that payments will start the last day of your statement period, okay? So Q3 just ended September 30th. So in your scenario, they would assume that your payments start September 30th, since that was the last day of the statement period. So that's the day they would use. Now, number 2 is age, okay? So they are basically talking about an assumed age, or how old is the participant on the annuity start date. That number is always going to be 67, and that's because that's the full retirement age for Social Security, okay? So when you're looking at this income stream amount, even if you're 25, 35, 45, the amount of money that you're looking at that you would receive in retirement is based on you being 67, okay? It's not you being 25, it's 67. Now, this is only different if you are currently older than 67. So if you're still working and you're 71, they would actually use your actual full age instead of 67. So those are the first 2. Then you have the assumed spousal and survivor benefits. Now, this is a whole other section, which is basically saying, okay, first of all, what is this benefit? So plan administrators have to illustrate a single life annuity, which will pay a fixed monthly amount for the life of the participants with no survivor benefit after the participant's death. And then they also have to do a qualified joint and survivor annuity assumption. So in that scenario, plan administrators have to assume that all participants have a spouse of equal age, regardless of the participant's actual marital status or actual age of any spouse. So even if you're not married, even if you're never planning on getting married, even if your spouse is a different age, you are still going to see that number on your account statement as well. They're required to do that. So what exactly is the survivor benefit part of that? Well, plan administrators must use, like I said, the qualified joint survivor annuity to show what the amount would be that the surviving spouse would receive for the rest of their life after the participant dies. So if I'm married, I have a spouse, let's say I die, my husband would then receive, whatever that amount of money is for the rest of his life, even after I've passed away. So that's the spousal and survivor benefits, okay? So then that brings you to the interest rate, right? So in this category, they are using the 10-year constant maturity treasury rate as of the first day of the last month of the statement period to calculate your monthly payment. So again, if we use Q3, which just ended, since that is quarterly, the last month in Q3 was September, and obviously the first day was Thursday, September 1st. So the treasury rate on that day was 3.26%. So that's what they would use for that part of this assumption. And then, of course, the last one, which is a bit of a bummer, mortality. So life expectancy under this assumption is based on the gender-neutral mortality table in the Internal Revenue Code. Very exciting, I know. So that's a lot of mumbo jumbo. Let's actually talk about what this looks like in actuality. So using a hypothetical example with Stephanie. So Stephanie is a single lady. She's 40 years old. And for her, we're going to use a treasury rate of 1.83%. And we are going to use the hypothetical date of December 31st, 2022. And on that date, Stephanie has $125,000 in her 401k. That's the lump sum balance. So for her, when she goes to look at her Q4 statement that her plan administrator would supply her with, what she would see is something that looks very similar to this. She would see her account balance, then she would see her single life annuity, and then she would see her qualified joint and 100% annuity. So in this example for Stephanie, she can see very clearly that at retirement, in 27 years, because she's 40, she would receive $645 per month for life. Now, if she were to get married at some point and she had a spouse, the spouse would receive $533 for life after her passing. Okay, so it's really nice how they lay this out. It's very straightforward, very easy to read when you know what you're looking for and what it all means. Okay, so that's Stephanie, that's hypothetical, right? That's great, but it's kind of made up. So let's actually look at my own 401k account, okay? So for me, I'm married, I am currently 32, and like I said, Q3 just ended. So on September 30th, 2022, my 401k account balance was $37,177.43, okay? And because of that, we would go back to September 1st, look at the treasury rate on that date, and it was 3.26%, okay? So those are the assumptions that we're working with. And for me, I went into Fidelity. I actually pulled up my Q3 statement, and I have pasted it here for you to see. So as you can see, it does show up on the statement saying, this is your lifetime income estimate. It says right here, your plan administrator has directed us to provide this estimate that shows how much monthly income you could collect at retirement. So for me, it's $221. That is what my $37,000 translates to currently, okay? So $221 per month for life, starting at 67. And then, as I mentioned, I am married, so if I were to pass away before my spouse, he would continue to receive $186 per month for the rest of his life after I pass away. So it's very easy to read, it's very clearly laid out, and I think it is good that this is being included, but I also did want to point out here at the end that there are definitely pros and cons to this. I think, as a positive, it definitely is interesting to see how your lump sum account balance translates monthly, because, I just never really thought about how that would be different. $37,000 in some ways feels like a lot of money, and in other ways not much at all, especially when you see that it's only worth $221 a month. It's kind of an eye opener, which, granted, I still have many work years ahead of me, but still, it is just, another way to look at the numbers, which I think is nice. And two, going off that, I think it really will help encourage people to save more, which, yeah, I mean, that's only a positive, right? However, I do at this point in time think there might be more drawbacks than positives. First of all, these are just snapshots in time. They're not accounting for new contributions. So they're just taking what the balance is now. They're not projecting what your monthly income would look like if you continued to contribute 21% each pay period for the next 25 or 30 years. Okay, so it doesn't account for new contributions. It doesn't include earnings growth over time, right? So it's not saying, hey, the stock market usually returns 8% a year. Let's include that in the assumptions. It's not doing that at all. It clearly also does not include future employer contributions. And I mean, the list really goes on and on. I mean, it doesn't account for inflation. Unlike Social Security, it's not, these payments aren't going to increase each year with a cost of living adjustment. So as life gets more expensive, your fixed monthly income, it's going to not take you as far. You're not going to be able to buy as much because things are more expensive, but you don't have the funds to cover it. So, yeah, I do think there are some drawbacks, but even with that, I do think that this is a good starting point, right? I think this is a good foundation that they can continue to build upon and change and grow so that over time it really does become more and more helpful for people to look at. And I think over time there will be more pros than cons. But yeah, right now I think there are definitely ways that it could be better. So with that being said, that is how I came to find out that my 401k was worth $221 per month. And, this is, like I said, a lot of people are going to see this on their account statement for the first time at the end of Q3. So it feels very timely to make a video on this because I think a lot of people are going to see it and not know what it is and have a lot of questions. So hopefully this video will help with some of that. I'm really into personal finance and love talking about it with other people and helping other people, get their financial ducks in a row, so to speak. So hopefully this video was helpful for you. If you have a question, drop a comment down below, or if I got some of my information wrong, let me know that too. Definitely don't want to put misinformation out there for people. I want this channel to be helpful. So yeah, if you liked this video, give the video a like, consider subscribing, and, go check out some of my other videos. My goal is to be transparent with, how I do my personal finances. So if that's of interest to you, I definitely have some budget videos up that I think would be really interesting. And, my goal is to continue to kind of make more videos as these cool financial topics and news stories come up. So thanks for watching, and I'll see you next time.